last part of IAS 28, investments in associates, investments in joint ventures. So hopefully you've gone through part 1 to part 3, which covers part 1, introduction and equity accounting, and part 2, which covered intra-group transactions, but downstream, and part 3, which covered intra-group transactions, but now upstream. So now we just want to cover the last bit on investment in associates. So what I want to start with is I want to focus on some of the intra-group transactions which we didn't do, but which are minor. So the first one that I want to focus on is you can have entity P. Let's say P is the parent company giving a loan to the associate. So when that happens, that means there is a loan receivable which is sitting with the parent, and let's say they issued out 10,000 and they have got 40% stake in the associate. But that means that in the associate also has got a payable of 10K relating to that loan. So given this one, this is also another type of intra-group transaction which you have. This one has to be eliminated as well. But remember, you eliminate only to the extent of the portion which you hold, which means our journal entry that we need to process for equity accounting becomes we need to credit our receivable to the effect of 40% of 10,000, which is 4K. So there's no amount which is going to come there, and then our investment in ASOC for 4K again. Then I also want to cover again, let's say another one is also dividends. So we've got our associate here, we've got our investor here, and the associate gives a dividend of 10,000. It issues a dividend of 10,000 to the parent. So again, the parent would have recognized a dividend income to the extent of that 10K, and the associate would also have dividends declared, which was straight in the statement of change in equity. It might be more now since they would have declared to all the shareholders, so you may realize maybe sitting maybe as just to throw in a figure, let's say it might be 16,000, which we have here. But to the extent of this 10,000, it's an intra-group transaction as well, which is supposed to be reversed. But this journal now is a bit unique. What you need to do is remember, we said under equity accounting, your dividend is not income, but it's supposed to reduce the value of your investment. So that means for this one, your journal entry will becomes you want to debit the dividend income to remove it, which is the 10K, and rather what you then debit is what you then credit is your investment in ASOC, again 10K, to actually reduce the value of your investment as per our discussion which we did on equity accounting. Okay, so those are some of the things that I just wanted to bring to your attention. Now, just a little bit of extras that I just wanted to share with you with regards to dividends on preference shares classified as equity. Remember, sometimes we've got preference shares. Preference shares are classified either as equity or as liabilities, depending on whether they're redeemable or they're non-redeemable. When they are non-redeemable, that is, they've got an equity characteristic, which we did in IFRS 9 last year. You then realize that since your investment in associate is through ordinary dividends, your preference shareholders have got a claim first to any profits before you have got your claim. So when you take your share of profits, you don't take those share of profits before the dividends of the preference shareholders. You first remove the preference dividends of the preference dividends for the preference shareholders. Then what remains is what you then allocate as your share of profits. Okay. Now the reason why I'm emphasizing on this is because Since the preference share would have been accounted for as equity, the dividend will not be sitting in the P&L, it will be sitting in the statement of changes in equity, which means that your profit after tax line item which you have does not consider the dividend as yet. So if you take your 40% and you multiply it to that figure, you get an incorrect share of profit. You first need to go and identify the dividend in the statement of changes in equity related to the preference shareholders, remove it, and then be left with what is supposed to be distributed to the ordinary shareholders. Then sometimes your associate stops making profits, they start making losses. So in that event, you also account for the share of losses. But obviously, as you account for your share of losses, that means as you account for it through equity accounting, you will be giving it to the investment in associate balance, which means the investment in associate balance starts going down and down and down and down and down. Now, you stop when that value of the investment in associate gets to a zero. You don't have a negative investment in associate, and that is covered by paragraph 28 of IAS 28. So you stop when it gets to zero. You don't continue. You only recognize an extra loss up when you get to zero. The only thing that you can exceed to keep on recognizing as a loss is only to the extent of any provisions which you want to raise. So if you've got an obligation, which might be constructive or legal or whatever, but if you've got an obligation which you have, which creates a provision, then yes, you're allowed to then raise a provision for that. And a good example would be if as part of your arrangement, you have got a transaction which you had not paid for with the associate, then that means to that extent there's an element of a liability which you're supposed to raise, which could have contributed to whatever loss making which might be in there. Then once the entity returns back to profitability, that also means you can't start recognizing the share of profits before you first wipe away all of those unrecognized losses which you had not put into the books. So as the associate returns to profitability, you first need to wipe away all the share of losses which were not in the books until we say the associate is now at profitability. It has netted off all the losses which were there in the past. Then these are now real profits. You only take real profits, the share of the real profits only. So for example, let's put it as an example. Let's say the associate in 2017 made a loss of 20,000, and then in 2018 they made a profit of 15,000. In 2019 they made a profit of 9,000. And assuming that in 2017 your investment carrying amount was 10,000, that means you could only you could only reduce your carrying amount to the extent of 10,000, which was there. Which means the other 10,000 worth of losses, you could not recognize these, they were outside the box. Then 2018, the entity returns back to profitability and your share is 15,000 of that. Of these 15,000, you cannot recognize the full 15,000 as a profit because the first 10,000 is going to address this amount which you had not recognized, which was the loss before, which means your share of profits in 2018 will only be to the effect of 5,000 after covering the losses which were there before. Okay. So that's what I also wanted to clarify. Then your investment in associates should also be tested for impairment. And you go through the normal impairment process. Remember, normal impairment process is you first start by assessing for any indicators of impairment. So for investment in associates, so it's an investment which resembles equity component, you go and test it using the impairment indicators in IFRS 9. Because your IFRS 9 is the one which covers impairment of your investment in stocks. So you first assessed for impairment in IFRS 9. If there is an impairment indicator as per IFRS 9, you don't go ahead and impair it using IFRS 9 principles. You then go to IAS 36 and use the impairment tests under IAS 36, which is basically you need to compare your recoverable amount and the carrying amount. If the recoverable amount exceeds the carrying amount, then there is an impairment. You impair your investment going downwards. But when you are impairing, so go to paragraph 40, 41, and 42. That then covers the impairment of investment in associate. When you are impairing, when you're looking for your value in use, remember your recoverable amount requires you to calculate value in use. So when you're calculating value in use, you need to consider either the future cash flows which will be generated by that associate, and then you present value them to today, or you can actually then multiply by your portion, or you can actually consider the future dividends which will be granted to you as a result of your investment in associate, and you can present value those ones. So those are the two models that are allowable for calculating value in use of investment in associate. So let's do a brief example just to illustrate these concepts. So let's say we've got an investment in an associate when you got 25% shareholding, and the carrying amount is 325,000 as at the end of 2011. Then the market price per share indicates that the market capitalization of the entity is lower than the book value of the entity, which actually means that the market regards the value of your business to be lower than the book value, which are the carrying amounts which we have in the books. So ideally what it means is your carrying amounts exceed what the market believes to be the value of your associate. So in that case, we are then told that the financial advisors of P Limited have estimated that A Limited will only pay 90,000 in dividends in future, which means we can use that dividend formula to come up with the amount. So a discount rate which will give you is 10%. What we need to do is we need to go ahead and say if the carrying amount of the investment in associate is 325,000, if we discount the dividends of 90,000 by discounting by 10%, do we get a value which is above 325 or get a value which is below 325? So if we do that, you then realize that the discounted figure of your dividends come to 225,000. So your carrying amount is not exceeding your recoverable amount, which means you've got an impairment loss. So you then go ahead and raise your impairment loss journal entry, which is you debit your impairment loss, which goes to the profit and loss account, and you reduce your investment in associate, which is the balance sheet figure, so the one which is in the statement of financial position. Once you do this, you're done with the impairment of your investment in associate. Then sometimes you can also make a decision that you now want to dispose of your investment in associate. So the moment you do that, you are allowed to actually dispose of your investment in associate. But the moment you do that, it jumps from IAS 28. You no longer account for it as an IAS 28, but you now account for it as a non-current asset which is now held for sale, which means it goes to IFRS 5. So for that one, the reclassifications are governed by paragraph 20 of IAS 28 and paragraph 21 of IAS 28. So what it specifically mentions is when you go to paragraph 20 and 21, it specifically mentions that what you need to do is you need to de-recognize only the portion which is now being held for sale. Now, the tricky part about it is you can have 30% shareholding, and then you decide that you want to dispose of 20% shareholding. So this is the one that you want to dispose of, which means you're now going to be left with 10% shareholding. So to the extent of 20%, this is now a non-current asset held for sale, so it will be accounted for under IFRS 5 provisions. But you've got this 10% which is remaining. And this 10%, the question is you account for it as what? So before the disposal of the 20%, you can still use your 20% to influence the decisions which are being made in the industry, which means this 10%, you still equity account it as an associate. Only until this 20% gets sold. The moment you sell this, you lose your significant influence because you're now left with 10%. So at the point of sale, this ceases to be an equity IAS 28, then this goes to IFRS 9 and becomes just an investment in a financial asset. Okay, so that one, please, you need to understand that one very well. Okay. Then when do you discontinue the equity method? Obviously, you discontinue the equity method when you no longer have any significant influence. So that means your equity method, there are two reasons why you could be stopping. So number one, you could be upgrading from significant influence to a level of control or to a level of where you've got no form of power at all, you've got no influence, you've got nothing really. So it means you can jump from IAS 28. So you are sitting at IAS 28, which is right here in the middle. It can jump from IAS 28 to move to a joint control or to a subsidiary where you've got full control. Or it can move the other way where you are losing your influence, so it becomes just an investment in an asset which is accounted for under IFRS 9. The most important part which you need to realize there is when you go to paragraph 22, okay, which covers that. So the moment you are jumping from an accounting boundary of IAS 28 to another standard, be it to joint control, but for joint control, it becomes a joint venture. Remember, you still account for it under IAS 28, so there won't be any changes in terms of the accounting. But if it jumps to a subsidiary where you now need to consolidate under IFRS 3 and IFRS 10, then at that point we then call this a step acquisition. So when you've got a step acquisition, this carrying amount which we had here, you then need to get into this new standard by fair valuing, and the difference between that carrying amount and the fair value goes to the P&L. Same applies if you're jumping to IFRS 9 here, then you first need to fair value your asset, so it comes into IFRS 9 at fair value. But you still need to compare now the difference between that carrying amount here and the fair value here, and the difference also goes to P&L. So each time you're jumping from an accounting boundary from IAS 28, you fair value first. The fair value difference goes straight to the profit and loss account. Okay, so that's IAS 28, ladies and gentlemen. I hope you did enjoy the 4 parts to IAS 28. No very complex principles being introduced here, but remember the key is to practice. The more you practice, the more you understand these, the more you become ready for the exam. So I need you to do the end of unit questions, which are there in IAS 28. I need you to do some past exam papers, which covers IAS 28. If you go back to our CTA level 2 tests for 2018, there are some investment and associates which we tested there. You can practice using those ones. Take any material from any university or from any book of descriptive accounting. Do some questions so that you get these on your fingertips. Otherwise, thank you, ladies and gentlemen. From here, what we're now doing is we're jumping from IAS 28. We're gonna do consolidations afterwards. So we'll be jumping into IFRS 3 and IFRS 10. So read that in advance. Okay. Otherwise, ladies and gentlemen, thank you very much. Danke, gracias.